Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall, and on today's episode, we have a very special guest with us today, Richard Chen. He is an RIA attorney, founder of Brightstar Law Group, which is a law firm that serves investment advisors, including wealth managers, family offices, hedge fund and private equity fund sponsors, and other financial advisors of all sizes, building strong businesses and avoiding regulatory and legal risks. So thanks for joining me today, Rich.
Oh, thanks for having me, Catherine.
We've worked on a number of cases together, so I always love getting to talk shop with, some of the, experiences that we have in the industry, just seeing what firm owners go through and that sort of thing.
Absolutely. I love that we have different, sort of lenses on what's going on, and we can come together and sort of make it work for the clients, right? So.
Yeah, exactly. Yeah. I always tell people that, they'll ask me questions, and it's, we don't let the tax tail wag the business dog. And, a lot of the times, some of the questions that I'll get back from clients, I always have to tell them, like, the attorney sets the tone, sets the dance, like, the risk profile is that's really, what's going to set the dance for us. But
accounting is so important that oftentimes one of the first things we ask folks to do, especially when they're setting up the business or they're selling it, is like make sure you have someone who's an accountant who can really understand the space. So
yeah, it's one of those things where, I always tell people certain components of it, like getting all your transactional reporting done, that can happen a little bit after the fact, but it's a lot of those foundational pieces of, how are you going to be taxed? What's the structure? Having having your bank accounts separated and not commingling funds and things like that, end up being, the things that sometimes I'll see people wait a little too long to get those, ironed out. You can't just run right into things, but
100%.
Yeah. So on today's episode, we were talking a little bit in the pre-show about going through, I think we both see a similar thing for firm owners. A common area of interest that I always, get from them is if they're breaking away, forming their own new firm for the first time, shifting from being, maybe a W-2 employee advisor to now they have their own firm, or they're coming into, equity, that their dynamic with the business really changes. And for a lot of them, unless they've gone through this process before, especially if they're going to be going through this process with another partner or somebody else that's joining them, and so they've got like a multi-owner equity entity that they're going to get set up, it's the first time that they've gone through this process. And for us to kind of talk through what's the basic foundation that they should be thinking about, in any RIA or any firm setup, to make sure that they're, in good shape to be able to grow and kind of walking through those first stages process for, the birth of a new firm.
Absolutely. I think a lot of folks get the first part right, which is make sure that you have a sort of a limited liability entity structure in place, right? Whether it is a LLC or a corporation, however folks choose to do it, they make sure that they have an entity, because if they do business right and do business through the entity, don't commingle funds, as you indicated, they will protect their personal assets from liability, right? Now, of course, even if you set up the entity and you mix the books and or the assets and don't keep records, then that arguably sort of leads to something, which is called piercing the veil, which is like basically the corporation or the LLC is not really sort of acting as it should be as a separate entity, right? I think most folks get that part right?
Yeah.
But what oftentimes is not looked at, especially, sort of folks understanding with a single owner, is setting an operating agreement.
Yeah.
But it's particularly important when you have multiple owners. And I think that oftentimes we see that when folks, try to bring on equity partners in the future, or they're trying to do succession planning down the road, is that there should be a governing document that sort of highlights how the business will run, right? And the operating agreement or shareholder agreement, depending on sort of how you sort of do it, has three major components to it, right? One is the management and governance component. Who is going to manage the business of the firm, right? And how are those managers going to be sort of elected or chosen, right? And what responsibilities will they have, right? Will they be able to sign documents, hire employees, make certain sort of decisions? What kind of decisions will require, a large number of the owners or all of the owners to make, to weigh in on it, right? And to approve it, because those are the kind of things that will impact folks, and their economics, right? The second piece is the economics. And of course, I think this is the piece that people oftentimes sort of focus a lot on, which can be, fortunately, at least in an LLC, sliced and diced however you want it, right? You can theoretically just basically carve out your book of business and the revenue you get and just take that. And each owner has their, sort of their own revenue stream. Or you can basically have a sort of common pool, common enterprise, and basically share the assets, as you're building enterprise value, right? But it's still important to make those decisions and to very, very clearly, sort of understand, what expenses, what revenue is going to be allocated to whom, right? The third piece is also very important, and those are the buy-sell provisions, right? What happens if something, God forbid, happens, death, disability, or something, bankruptcy, divorce, or, what if folks want to retire or leave voluntarily, or God forbid, be terminated because they did something that was pretty bad. There should be a mechanism in the operating agreement for figuring out how the parties will end up separating in the event that happens. And it's never a pleasant thing to think about, I think, and which is why I think oftentimes these conversations get pushed down the road, right? But it is important, because I think it's a healthy conversation that helps to frame where you're headed as a business, right? For instance, if you decide that you want to allocate, revenues in a certain way, that you have your own book, that's fine. It's philosophically very different from sort of pooling your assets, right? As opposed, so basically these decisions, though, really help to shape, or to build the frame, and to hopefully level set expectations so that the parties are on the same page as they move forward. Now, of course, things can change over time, but at least you have a good foundation for where things are going. And if unfortunately something happens, you have a clearer sort of defined path in terms of how to resolve any issues.
Yeah. And I think, somebody had put this, I don't remember who to attribute this to. This isn't mine, but it's always good to do the fire drill when there's no fire. I think with a lot of those exit provisions of, you don't want to have to be having these hard conversations when, you're dealing with the partner that just got the cancer diagnosis and is going to have to bow out of the business. Like it's much easier to have these conversations when everybody's healthy and well, and you're at the beginning of things. And,
absolutely.
And then I think too, a lot of what I'll end up seeing in a lot of these engagements, something that we end up doing oftentimes for these new entities is, they work through some of these components of how they're going to be doing things economically in terms of where the revenues are flowing. But common issues that we'll encounter is, if you've got advisors where they're getting a lot of, say insurance commissions or something like that, that's not eligible to be paid into the entity.
Sure.
How do you define those rules of, what's going to, if the entity is carrying the overhead of the staff and the technology, how does that get accounted for? And, I think for a lot of them, especially when it's a multi-owner entity, modeling out some of, how their accounting flows are going to go.
Correct.
So, at what level does revenue get recognized? Like, is it going to show up on your personal return? Is it going to show up in this entity? And how do you decide, what's going to be shared expenses and what's not? Because, are things like your conference travel, are you going to pool that and the partnership's going to pay for it? Or are you going to, if you want to take your clients on a trip, does the firm pick that up or do you pick that up? A lot of those kinds of questions. And then just how are we going to decide what's, how people are going to get paid? And Is it going to be a revenue-based allocation? Is it going to be a different calculation? Is it going to be based on hours? Is it, how are you going to, is it just going to be based on pure equity? Are you going to have a guaranteed payment component and, a K1 distribution? And what's the most tax efficient way to do all of those things? It's, there's a lot that goes into it right when you get started. But
absolutely. And I mean, I think those are all sort of very important decisions to make, because different people will very likely have different expectations. And I think Catherine and I have both seen, unfortunately, situations where things go bad, right?
Yeah.
And that's definitely not the time. Unfortunately, I've seen business divorces and they pull out the operating agreement and it's totally sort of not what, or, it didn't cover sort of what they're talking about. And so it gets messy.
And I've experienced, I think I've had this actually happen a couple of times this year where people were thinking about forming an entity together. And by going through the process of doing the operating agreement and having initial discussions with us of just, how do you, partner one get paid? How does partner two get paid?
Yeah.
And, asking them a lot of these kinds of questions from an operations perspective. And they ended up, they couldn't come to an agreement on it. And it's like, well, it's sad, but at the same time, I'm glad that they've figured that out now. Absolutely. And not, trying to split the baby of, a $200 million firm.
Yeah, that's right.
So I think it's an annoying, I think, exercise for a lot of advisors, because I think the sentiment that I get from a lot of advisors is just so action oriented, forward moving. They want to be in the relation, they having to deal with some of these issues. Like they're emotional conversations. It's also, probably not your kettle of tea because it's, or not your cup of tea because it's, corporate governance, which is, can be a brand new experience for a lot of people. But it's, they're definitely essential, I would say.
Yeah.
To set that good foundation.
Well, I think that foundation also helps as you grow bigger, right? So if you have a proper governance structure in place, who's in their roles and which seat they're sitting in. And as you grow, of course, you can evolve, but at least sort of where you're going. And then, that definitely sort of provides, I think, sort of an extra tailwind for growth too.
Yeah, absolutely. So I guess, for these firms in their, first couple of years of maybe forming a new entity, maybe they're a breakaway, and you've got a multi-owner setup. Are there other components of their legal infrastructure that you see often are surprises for the firm owners, or things that they, I think everybody knows, like, you got to file new tax returns and, all that kind of stuff. But common surprise points that you hit with people of things that maybe they don't expect, or like mindset shifts that you end up, having to make with firm owners where it's in their first couple of years of operating. Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener.
Yeah, I think one of the big sort of touch points that often happens, and so we're oftentimes brought in, is when people are growing and then they want to add new folks, right?
Yes.
And so when there's new equity, and the reality is that can be exciting for folks, but it also potentially has ramifications on how the firm was set up, right?
Yeah.
Because there's certain structures that don't allow for certain types of equity to be granted. For instance, if you elect S-Corp treatment, which is understandable from sort of a tax standpoint, especially if you're sort of not having to pay a lot more in terms of self-employment tax. But you also limit yourself in terms of what you can have in terms of the owners of the business. They all have to share, proportionally in relation to their ownership in the economics of the firm. You cannot slice and dice. You also can't have profit interests, which are a kind of, sort of capital interest or equity interest that you can give, sort of new employees who come in later, who participate in the growth after they become, or after they're given that profit interest, as opposed to sort of the value that's already built up to date. They don't have to participate in that. The problem is that S-Corps can't allow you to have those types of structures. Now, there are, of course, other ways that you can sort of mimic that, but they have different tax ramifications for employees. So, that is definitely sort of one of the big things that we see, is that whether or not folks, sort of default to the partnership tax, sort of treatment, which provides more flexibility, or the S-Corp election, which unfortunately, I think once you take it, you can correct me if it's wrong, but I think you can't go back, right? Once you for 5 years since once you elect that treatment.
Yeah, it's complex to unwind them, like especially too if you've got property involved, like that can get really goofy really quickly. But usually I end up seeing a lot of times when I have these conversations with advisors, because when we're doing a lot of the entity formation work or involved in those conversations, my question to them is, okay, well, what's 5 years down the road look like for you? Like, who's going to be exiting first? How are they going to be exiting? Like, are you going to be changed? Do you anticipate in the future the need to be able to add on new equity people? Like, is that your intent? Like, how do you intend to grow this? Because if they have those factors going on, oftentimes S-Corp is just not going to be an appropriate vehicle for them.
Sure.
And so I think for these more complex, more modern, style practices that I'm starting to see these case, facts come up more frequently. They need more flexibility. And so we end up going for a more complex entity structure.
Absolutely.
So a lot of times what we'll end up seeing is, I always hate doing this because I don't like making more complexity unless we really need it. It's because it's pain. It's another layer of filings. It's painful to administrate. But at the same time, I was doing a case recently with a couple of advisors where it's a succession plan, and one is buying into the firm, and they needed a lot of flexibility with how they were getting compensated, because they wanted to be compensated based on revenue performance. And then also one of them was going to be taking over more administrative management of the firm, but they wanted to make sure that everybody was being fairly compensated, for the fact of, if one of them is doing more management, he's not going to be able to be bringing in more, revenue.
Sure.
But that shouldn't be a ding. So like those kinds of issues. And so they needed more complexity. But then at the end of the day, being in the partnership structure versus being in the S-Corp structure, when we ended up doing the math out for them, being able to stay in the S-Corp structure was going to end up saving them like $40,000 a year in taxes recurring for really not a lot of legwork. We're talking about another round of return filing and a couple of W-2s. Like, it's not, this isn't, we're not having to do a lot in order to achieve that. But, I think for them too, the level of flexibility that they wanted in being able to expense things really ended up being, part of that decision making as well. And so I always hate seeing that level of complexity, because it's, for a lot of firm owners, it's, it adds another layer that they have to deal with. But at the same time, when you want that flexibility, it can be available to you. I feel like a lot of times I always tell people, tell me the operational outcome that you need to get.
Right.
We'll find the most efficient way to get you there.
That's exactly it. Yeah, that's exactly it. I mean, I agree with you. I think that I agree. I like simplicity as well. I think simplicity is, one, easier to understand, and sort of less likely for unmatched expectations, but also less risk. But ultimately, it's really what the firm, sort of what the owners want, and that should really be what drives the decision. So.
Yeah. And I think, another challenge that I'll come across a lot of times too with, advisors in this position is, it can be their, for a lot of them, it's their first rodeo, like when it's their first succession or first time adding on a new partner and things like that. And, it's difficult to make a lot of these business decisions, as kind of in a vacuum. A lot of times I'll get the, what does everybody else do?
Yes.
Question.
Yeah.
But it really depends on, your specific needs, what you're trying to achieve. And every firm is so different, and how, how the services are delivered, who are the people, so your tax and accounting and legal answers are going to be driven off of that.
I think that's true. I think, the way I look at what we do is, that's part of what is, what we try to bring to the table. As service providers, I think knowledge is definitely important, but being able to understand that oftentimes this is the first time that folks are going through these things. So there's a certain amount of sort of hand-holding, and also just understanding that there's a lot emotionally involved.
Yes.
And really just being available and sympathetic to the fact that this is definitely something new is very important in terms of what we do.
Yeah, absolutely. 100%.
Yeah.
And I think it's I always enjoy the opportunity to do the more complex planning, because it's very rewarding seeing,
Sure.
some of the things we can get done. And
Oh yeah,
especially
absolutely.
when you see these firm succession plans go off well, and it's,
Yeah.
I always love listening to the advisors talk about their practice,
Yeah.
because like I had one of these conversations earlier this week with someone I was meeting for the first time. And um, you know, there's just so much love that they put into building their
Yeah.
firms up. And
Mm-hmm.
it is such like a fear point stepping
Yeah.
into the next level of what that's going to be, whether it's bringing on a new equity partner or
Mm-hmm.
exiting and selling.
Mm-hmm.
um, and it is just such a large personal decision.
Yeah.
uh, so
Yeah.
being part of that, I'm going to give you as much information as you need to make the right decision for you. I'm not going to make the decision for you, but I
Yeah.
want you to be fully informed of
Sure.
what the different, door A is going to be like this, door B is going to be like that. Um,
Absolutely. Yeah.
but I guess in terms of, maybe kind of talking a little bit through the life cycle. So you've got the formation process,
Yeah.
where
Yeah.
operating agreement is a really core component of that. And then,
Mm-hmm.
during the life of the practice, maybe you're adding on equity partners, and so needing
Mm-hmm.
to revisit that.
Mm-hmm.
But then, maybe for us to just talk a little bit about exit,
Yeah.
how that, some of the legal components that maybe surprise people when you're working with them, when
Yeah.
they're going through the exit process.
Yeah. So, I mean, there's so much, that's involved in the exit, and the two major paths are, sort of internal and external, and they're
Mhm.
extremely, extremely different. And
Yes.
people have different sort of reasons why they opt for one versus the other. Oftentimes, my experience, the internal succession, it takes longer, and
Mhm.
but it's oftentimes folks who are super passionate about making sure that they maintain what they've got going, and just want to hand it down to employees that they're looking to sort of elevate. And the external transactions are great too, and variety of reasons for doing them, in terms of wanting to grow the practice, expand, and sort of spread their wings is great. A lot faster, but they're very different, and
Mhm.
they have their own sort of complexities. Oftentimes, with the firms that are doing an external transaction, they're joining a new firm. So psychologically, it can be challenging. If they're getting equity in the new firm, it's necessary to look at that. And increasingly, we're seeing a lot more deals with equity. And
Mhm.
how are they going to protect the fact that they have deferred compensation, retention payments, and earnouts? Can they make sure that they are sort of stay employed through that entire period? So a lot of that, and then operational integration, right? Which you don't have in an internal succession, but the internal
Mhm.
succession takes longer, right?
Yeah.
There's a elevation, sort of deciding who will sort of take the reins, and how are you going to sort of transition ownership and client relationships, right? And oftentimes the internal successors don't necessarily have the same finances to
Yeah.
fund it. So you have to
Mhm.
think strategically about how to put these deals together, because it's going to look very different than you'll see for an external transaction.
Yeah, and I actually had a couple this year, where there was an external transaction, and it just the way you worded this reminded me of a case where
Mm,
was going to basically sell, merge to a larger firm. Was getting a lot of. I was surprised at how much of the deal structure was equity,
mm,
and ended up after the fact. He decided to back out of it for a number of reasons, but I think the main reason was I don't want to go back to being an employee again.
Mm-hmm.
I'm so used to being able to call
100%.
the shots on my
Yeah.
practice and just
Yeah.
realizing, oh, like I'm trying to exit out of this, but it's not
Yeah.
really going to be an exit.
No. Yeah, I absolutely agree with you. I mean, that's one of the first conversations I have with folks. I want to make sure they, so they have the perspective of how things change and don't change, depending on the circumstances, and so that hopefully they have sort of more visibility into, whether or not this is the right choice, because ultimately that's what's important, right? It's not just a matter of getting the deal done; it's a matter of making sure that they're set up in the right way for whatever that goal is, or whatever they envision that next chapter in their life to look like.
Yeah, absolutely.
Yeah.
So for those of us, for those in the audience listening, wanting to get into your world, Rich, what's the best way for them to learn more about the work that you do for firms and kind of how you support firms?
Yeah. So, I mean, I publish a lot on LinkedIn, so connect with me on LinkedIn. Rich Chen, Bright Star Law Group. I also publish in some, publications, industry publications as well. Our website is www.brightstarlawgroup.com. Or you could email me, rich@brightstarlawgroup.com.
All right, that's great. And we'll post all those links nearby wherever, listeners are tuning in. Any closing thoughts or anything that we didn't, I think hit in detail that you'd like to leave the audience with?
I think we hit a lot of sort of what it is. I mean, I think what we do here is really to make sure that that we are sort of helping folks to understand sort of what the options are, and then help them to find the goals, to get to the goals where they're trying to go to. And there's oftentimes a number of tools to get there, right? And we can sort of sort of help with those. And so yeah, I mean, I think really love what I do, and I think it's exciting to be able to elevate a lot of these advisors and to see them grow, and to see them move to sort of in the direction that they want to go. So yeah.
No, and they do it fast. Like I worked with a lot of different industries over my career, and I'm always impressed. Like, I'll have these conversations with the client, and it's okay, revenue's targeting for this number for this year, and then we talk to them again 6 months later. It's like, yeah, we totally blew that out of the water.
It's amazing. It's absolutely
it's amazing
incredible.
how much they can grow.
100%. Super impressive.
Yeah, so they're wonderful to work with. Well, thank you so much for coming on the show. I appreciate you taking the time.
Well, thank you so much, Catherine. It's been such a fun time with you. Thank you.
So for those of you listening, this was the Financial Advisors Want to Know podcast. I'll post those links nearby where to get in touch with Rich if you're interested in learning more. I definitely recommend connecting with him on LinkedIn because he puts out excellent content there if you're a frequent LinkedIn person like I am. I'm always interested to hear about what you thought about the episode. So feel welcome to send me a DM as well, because we're always trying to make these more useful, more tactical, and really focus the episodes on where you're trying to drive your practice and what are the things you want to know as you're growing your firm. So thanks again, Rich, for coming on. And this was an episode of the Financial Advisors Want to Know podcast. Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.